John Maynard Keynes was a very famous English economist from Cambridge who's well known for, among other things, his heuristic characterizations of financial markets. In particular, in his famous book, The General Theory of Employment, Money and Interest, published during the Great Depression in 1936, he characterized the stock market as a beauty contest. He further characterized it as being unstable and volatile due to the speculation of human participants who could not rein in their animal spirits and only take fully deliberative actions. Keynes was also famous as an investor and is said to have made and lost many fortunes. He was also a keen observer of market and human behavior. In The General Theory, Keynes described a beauty contest run by a newspaper. Of course, this contest was just a useful invention from Keynes' mind. In the contest, the newspaper would publish photographs of 6 women. Then the readers would submit their votes for the woman that they thought was the most beautiful. I should be more precise here. I should say that the readers supposedly would vote for the woman that each thought was the most beautiful. Although each reader was asked to vote for the woman they thought most beautiful, what were the actual incentives embedded in Keynes' invention? A reader could only win the ultimate prize if that reader had picked the woman that most of the readers had picked as most beautiful. Then, among those that picked the most beautiful woman, there would be a random drawing. So if you wanted to get a chance at the prize, you didn't really want to vote for the woman you actually thought was most beautiful. Rather, you wanted to vote for the woman you thought the most people would vote for as being the woman the most people voted for. Notice that I did not say that you would vote for the woman you thought the most people thought was the most beautiful. If I did, that would imply that only you understood the game, that all other people were voting for the woman they actually thought was the most beautiful. But if you are not the only one who sees the distinction, then some, maybe not all, people would be voting for who they thought the others would be voting for, where the reason they were voting for a particular woman was sometimes because they actually thought she was the most beautiful, but other times because they merely thought that others would be voting for her. Wow. So this is the crux of why the stock market is a beauty contest. You don't really want to buy the best firm before everyone else does. Rather, before anyone else does, you want to buy the firm that other people will want to buy. And if everyone is doing that, you might get the market chasing its tail, rather than chasing good companies. Thus, good investors are not necessarily those that can actually find good investments, but those who can predict what stocks others will want to pick. Of course, if everyone is just picking the most beautiful stocks, then there is no problem with picking the stocks that everyone picks. Those are the best. But if others are not picking the best stocks, then by trying to pick what they pick, you might not pick the best, or you might pick not the best. And if they are trying to predict what you are picking, they may also not pick the best stocks. In that sense, the market creates its own alternative reality that has nothing to do with whether it's actually a good investment or not. And if everyone is trying to predict what everyone else is trying to predict, you can see how this might become very unstable. And if you also add animal spirits, then it is clearly unstable. To see this, consider the following simple game some have called the marriage game. There are 2 people who like opera and sports. Dave likes opera intensely, and he also likes sports, but less intensely. To put some numbers on it, let's say that Dave gets 10 units of happiness out of opera and 8 units of happiness out of sporting events. Sometimes I'll call these units of happiness utils. Diane also likes opera and sports. She's a little bit intense about it. She mildly prefers sports to opera. I've done some extensive analysis and determined that relative to Dave, she gets 8 units of happiness out of sports and only 7 out of opera. Dave and Diane also like each other and like to spend time together. In fact, if they are together, that generates another 2 units of happiness for each, independent of what they're doing. Thus, if Dave is with Diane at the opera, he gets 10 plus 2 or 12 units of happiness, and Diane gets 7 plus 2, 9 units. Similarly, if Dave and Diane are together at a sporting event, then Dave gets 8 plus 2 or 10, and Diane gets 8 plus 2 or 10. But if they're apart, they like what they like, and they're getting just what they get, right? They don't get any extra by being together. They decide that they deserve one night out a week together. On Wednesdays, they either go to a sporting event or they go to the opera. One Wednesday, they both went off to work and forgot to discuss where they were going that evening. Just to keep the game interesting, it turns out that Dave works alone and his phone was on the fritz. Also, the music hall is on the other side of town from the sports arena. The question is, where should each go? And which is actually the best? What's going to be the outcome? If you were married to Dave or Diane, what would you do? From Dave's perspective, he would try to put himself in Diane's shoes. What would she do? So this is just like the beauty contest, in that Dave is not thinking about what he wants alone. If alone, he wants what he wants to go to the opera. But if he goes to the opera and Diane picks what she wants to do alone, then she will go to sports and they will be apart. So if Diane picks sports, the best thing for Dave to do is to also pick sports. But what if Diane thinks that Dave will pick what he likes to do alone, and she picks opera? If she picks opera, the best thing for Dave to do is to pick opera. Dave's now confused. He muses, is Diane going to be selfish tonight, or is she going to be thinking about what I want? And then it comes to him. Perhaps he should do the same type of analysis he just did, but from Diane's perspective, to see if she has a dominant move. From her perspective, she thinks if Dave goes to the opera, then the best thing for her to do is also to go to the opera. But if Dave goes to sports, the best thing for her to do is to go to sports. So what she wants to do depends upon what Dave wants to do, but what Dave wants to do depends upon what Diane wants to do. There's an indeterminacy here. Not sure what's going to happen. In economics, we would say that there are multiple equilibria. By the way, what we just went through is consistent with the notion of play and game theory of John Nash, the person the movie The Beautiful Mind is based upon. The idea is that Dave examines what is best for him if Diane picks one action, say opera. In this case, Dave should pick opera too. Then Dave puts himself in Diane's shoes and asks if he picks opera, is the conjectured action of Diane, pick opera, the best thing for her to do? If the answer is yes, which it is in this case, then we have a potential solution. It is only an actual solution if, when we do the same thing for Diane, it is the case that if she picks opera, opera is Dave's best response. It is in this case. This is called a Nash equilibrium. The important thing to note is that this game has another perfectly reasonable Nash equilibrium, and that's when they both pick sports. This is the beauty contest, and in some sense it is unstable, as Keynes said, because we have to guess which equilibrium strategy people will play. In fact, Dave and Diane may just flip coins, and that's too bad, since half the time they are apart, and of those times, half the time someone is going to be at a different venue than they would prefer to be at. This example also points out the incentive to communicate and coordinate. On the first time they go to a different venue, when they get home, they will probably agree that if it ever happens that they forget to discuss where to go on that Wednesday night, and either Dave or Diane's phone is on the fritz, that they will go to the opera. Such coordination might work in a game of marriage, maybe not, but when was the last time you coordinated with the market on the stocks they thought were the most beautiful? All right, this is a very long introduction on our next topic. The point I want to stress out of the preceding discussion is that an investor may need to predict what other people feel. The next topic is to discuss how economists model investor behavior. Before we get started, I have a few caveats. First, I am not saying, after we look at how financial economists model human behavior, that you will be able to predict what everyone will like before they like it. Or, to paraphrase Wayne Gretzky, that you will be able to skate to where the puck is going, not where it is now. The reason we will discuss how financial economists model human investment behavior is because all asset pricing models are based on the notions laid out here. An asset pricing model is a collection of assumptions that generate a set of implications regarding what is risk, and how it is best measured, and how much extra return a person should get in excess of the risk-free rate for bearing it. That is, an asset pricing model determines the appropriate discount rate to use when determining the present value of an expected future cash flow. Thus, an asset pricing model allows you to price securities. And then, using the price implied by the asset pricing model, you can compare that to the price in the market to determine whether the market price is a good deal or a bad deal. As is true with any model, the implications of the model may miss something important. For example, a model may tell you something that is not risk when in fact it is. In that case, investors will discount the prices of securities that have that something. Then, according to the model, it will look like it's a good deal when it really isn't. In order for you to have intuition on when that occurs, you need to know how the model was built, not just its implications. All models start from the material discussed in this section. It is important for you to have a sense of the foundation of these models. As we discuss these models in subsequent lectures, I will highlight the implications that stem from the way humans are modeled in this lecture. In this lecture, I'll point out what I think are very strong assumptions that produce overly narrow implications in some of the most often used asset pricing models. By the way, since most of the models in physics can't explain half the matter in the universe, I don't feel so bad about what happens in finance. Okay, so let's consider how financial economists model individual behavior. Let's start with an individual. The tradition in economics is to index individuals as I and J, as in the ith person does A and the jth person responds by doing Z. To make this a little less impersonal, I will refer to Ichabod for I and Jane for J. The atoms of economic analysis, i.e. the most primitive building block, are consumption bundles: preferences, opportunity sets, and choice. A consumption bundle is any combination of goods and services. For example, here are 3 different consumption bundles. Consumption bundle A is 12 cans of beer, 4 bags of potato chips, and 1 umbrella. Consumption bundle B is 1 bottle of Chardonnay, 12 oysters, and 1 umbrella. Consumption bundle C is 1 bottle of Chardonnay, 4 bags of potato chips, and a plastic poncho. Let's build a bit more structure so that we can see how the setup is very general. Let any specific consumption bundle consist of a list of the amounts of every single good and service in the universe. The items on the list may also be state dependent, like an umbrella on a rainy day 3 years from now. If there are k different goods and services, then a generic consumption bundle, say the mth out of many, is a vector x sub m is equal to x1, x2, x3, all the way up to xk, where x1 is the number of units of the good or service 1, x2 is the number of units of good or service 2, etc., all the way up to the last, the kth good. Note that the lowercase x denotes a particular number of an individual good, whereas the cap X denotes a particular combination of all the goods. Next, we can characterize an individual's opportunity set as the subset within the set of all possible consumption bundles that individual can afford. Sometimes the opportunity set is defined by a budget constraint. That is, out of all of the possible combinations of things a person can get, only those things that the person can consume with the budget that they have. Once we have the opportunity set, we need an individual's preferences over those opportunities. Preferences are modeled as follows. A set of preferences is a set of orderings for any 2 pairs of consumption bundles. For example, if the 3 consumption bundles previously described are the only possible consumption bundles, then Ichabod's preferences might be fully characterized by A is preferred to B, A is preferred to C, and B is preferred to C. Jane may have different preferences. She may have the following ranking. B is preferred to A, C is preferred to A, but B is preferred to C. Okay, here's where things get a little dicey. Rather than have preference rankings for every pair, economists use a utility function that takes as its argument the number of units of each goods and spits out a number that is an index of happiness that person achieves with that bundle. This notion may seem a little strange to some people because it entails assigning a number to a feeling of happiness or satisfaction. How can we do that? Can a single number capture the nuances of your feelings? For our purposes, the numbers don't have to have any intrinsic meaning. All the utility's numbers have to do is rank alternatives. That is, for any pair of consumption bundles, the utility numbers must be such that the bundle that is preferred results in a higher number than the less preferred bundle. A utility function, say u sub j for x, that represents Jane's preferences must be such that u sub j sub x1 is greater than u sub j sub x2 if and only if Jane prefers consumption bundle x1 to consumption bundle x2 for all possible pairs of consumption bundles. Note that I didn't say that Jane has a utility function. Rather, Jane has preferences. An economist might be able to represent her preferences with a utility function provided that function ranks bundles according to her preferences. At this point, there are a bunch of questions that economists like to ask, such as, for any given set of preferences, does there exist at least one utility function that will represent those preferences? And if there does exist such a function, does that function have any nice properties? Such as, is it continuous? Does it always have a derivative? Things like that. The answer is that not all preferences have representations that are well-behaved functions. Rather, there are some conditions that, if imposed on preferences, will result in well-behaved utility functions. One of the reasons economists want to impose these conditions is not because they think that they reflect people's preferences. In fact, in some cases, the conditions needed to generate well-behaved utility functions are violated by perfectly sensible preferences. The reason we impose these conditions is because we want to use the mathematical tools of constrained optimization. And we can only do that if we have well-defined or well-behaved functions. With well-behaved utility functions, we can use the mathematics of constrained optimization to maximize the person's utility function subject to the budget constraint. The answer to this constrained optimization hopefully is predictive of how people pick among alternative opportunities. But if the function does not really reflect a person's preferences, then that solution is going to be kind of dicey. Okay, now finance is based upon money and wealth. As such, we need to translate utility functions on consumption bundles into preferences over wealth and income levels. This is actually pretty straightforward. A person's utility must go up if they have more income or wealth. As income or wealth increases, the budget constraint lets in more consumption bundles. With more consumption bundles to pick from, the person must be able to do at least as well as they did before, probably better. An indirect utility function is the answer to the following question. For a given person's utility function over consumption bundles, what is the maximal utility that person can achieve with a given level of wealth? So for example, let's say you have a monthly budget of $10,000. There are a bunch of things that you could buy with that in a month's time. You could buy stocks, bonds, vacations, healthcare, Chardonnay, potato chips. The stocks and bonds, by the way, allow you to maybe buy better vacations in the future. Let's say that when you pick the consumption bundle you like best, you achieve a level of happiness of 12,000 happiness units. If so, then the indirect utility function you have would be U of $10,000 is equal to 12,000 units of happiness. If you were to have a monthly budget of $15,000 instead, how much happier would you be? Given all the things that you can afford with $15,000 per month, you pick the consumption bundle you like best. Let's say that the bundle generates I don't know, 13,476 units of happiness. Your indirect utility function is then U of 10,000 is equal to 12,000 units, and U of $15,000 is equal to 13,476. Once you have an indirect utility of wealth function, i.e. we know that the U of 10,000 is 12,000 units and U of $15,000 is 13,476, you can then start to ask how you would feel if in happiness units if the amount of wealth you had was random. Now we're talking finance and investments. Economists refer to these preferences as preferences over lotteries. We define a lottery as anything that makes our future wealth random. A literal lottery is one example. You reduce your current wealth by $1 to get a very, very small chance at winning, say, $45 million. An investment in a security is also a lottery, since you can't know for sure what your return will be into the future. An investment in a house is also a lottery. An investment in an education is a lottery. In fact, almost anything is a lottery. So how do economists model your preferences over lotteries? The most popular way is according to the expected utility hypothesis of von Neumann and Morgenstern. The expected utility hypothesis says that a person's preferences over lotteries can be captured by the expected value of a carefully chosen indirect utility function. Let's see how this might work with a simple example. Let's consider three consumption bundles, X1, X2, and X3. Let's say if you had $10,000, you would buy X1 out of all those choices you had available to you. And if you had $15,000, you would buy X2. And if you had $17,000, you would buy X3. In terms of indirect utility functions, it might be the case that U of $17,000 is bigger than U of $15,000 is bigger than U of $10,000. In fact, that must be the case. Note that there are many such functions that capture your preferences over money. The following will work. U of $10,000 being 3, U of $15,000 being 12, and U of $17,000 being 13. This works because the functions maintain order. You like more income to less, but this different function works just as well. Let's let G of $10,000 be 10, G of $15,000 be 15, G of $17,000 be 17. All right, more on this later. Now let's say you're facing the following two lotteries. Lottery 1 is a 50-50 chance at either $10,000 or $15,000. Lottery 2 is a 60% chance at $10,000 or a 40% chance at $17,000. Let's say you prefer Lottery 2 to Lottery 1. According to the expected utility hypothesis, there exists an indirect utility function, maybe it's U, maybe it's G, or maybe it's something else entirely, that will capture your preferences if we take the expected value of the utilities that are possible. Let's see if U above captures your preferences. If U captures your preferences over lotteries, then the expected utility under Lottery 1 should be smaller than the expected utility under Lottery 2. The expected utility under Lottery 1 is what? 0.5, 50% times 3, the utility under 10,000, plus 0.5, the probability of the 15,000, times the utility you get under the 15,000, which is 12. That equals 7.5. The expected utility under Lottery 2 is going to be 0.6 times 3 plus 0.4 times 13. That's equal to 7. That is, U says that Lottery 1 is better than Lottery 2. So that function does not represent your preferences over lotteries. All right, what about G? The expected utility of the lottery is then going to be what? 0.5 times 10 plus 0.5 times 15, that equals 12.5. And under G, the expected utility of Lottery 2 is going to be 0.6 times 10 plus 0.4 times 17. That's 12.8, which is greater than 12.5. This indirect utility function does capture your preferences over lotteries, at least over these two lotteries. It may not work for other lotteries. And there are clearly other functions that will also work for your choice over those two lotteries. So what we need for each person is to find a function that for that person captures their preferences over all possible lotteries. Once we have that, we can start to predict people's answers to the following questions. How much would I be willing to pay to get rid of a risk that I face now? Alternatively, how much would I have to get paid to bear a risk I don't have now? To see this last point, let's say that you have an indirect utility function. Let's say that we have an indirect utility function for Jane and one for Ichabod. Consider a plot of Jane's. Also consider the lottery 1 described previously. Let's say that Jane already faces this lottery. Say she is a really bad driver and she has a 50% chance of being in an accident once a month, and that's going to cost her $5,000 since she's uninsured. For simplicity, let's let the only kind of accident she has be one that costs $5,000 to fix. Without the accident, she makes $15,000 a month and achieves an indirect utility of, say, 10. With the accident, she only has $10,000 after she fixes the car. She only receives an indirect utility of, say, 3 in that case. Given the risk, her expected utility is going to be 0.5 times U of 10,000 plus 0.5 times U of 15,000. That's equal to 0.5 times 3 plus 0.5 times 10, which is equal to 6.5. Note that her expected income is $12,500. Right now, she never really gets that outcome, right? Rather, she only gets its expectation by getting $10,000 half the time and $15,000 the other half the time. But how would she feel if she were always to get $12,500 every month? Would she be better off or worse off or indifferent? Let's say that she's indifferent. If so, then it must be the case that the indirect utility function at $12,500 equals what? 6.5. Because the expected utility of the 50-50 lottery is 6.52, Jane is indifferent between the two cases, the lottery and the sure amount. That is, she only cares about the expected income. The variance in the income is unimportant to her. In this case, we would say that she is risk neutral. Note that there are 3 points on this indirect utility function, and we can say that this function is a straight line. If at 10,000 we have 3, and at 15,000 we have 10, then a straight line that goes through both those points goes through 6.5 at 12,500. Thus, an indirect utility function that is linear in wealth is consistent with risk neutrality. Now let's say that Jane actually prefers 12,500 for sure to the 50-50 lottery over 10,000 and 15,000. In that case, we would say that she is risk averse. Also, it must be the case that the indirect utility function that captures her preferences is bowled like a bowl facing down. That is, the indirect utility function at 12,500 must be greater than 6.5. Let's say it's 8. If so, then the slope from 10,000 to 12,500 must be bigger than the slope from 12,500 to $15,000. Specifically, the change from $10,000 to $12,500 is 8 minus 3 is 5, and the change in utility from $12,500 to $15,000 is only 2. Thus, a function that goes up, it goes up at a decreasing rate. That's a function that is consistent with risk aversion. To see why that captures risk aversion, think about how Jane would feel if she were started out with $12,500 a month for sure. And something happened to increase her risk such that half the time she only had $10,000, while the other half the time she had $15,000. Her expected income is still $12,500. But what happens to her expected utility? It falls. On the downside, she loses 5 utils. On the upside, she only gains 2 utils. The expected change in happiness is thus, what? 0.5 times minus 5 plus 0.5 times 2 is negative 1.5. That is, her happiness falls. The drop on the downside is worse than the potential increase in utils on the upside. To think about this, What is the shape of Jane's indirect utility function if she were actually a risk lover? I'll let you think about that on your own. In summary, the shape of the indirect utility function tells us something about people's aversion to variation in outcomes. So how do we get indirect utility functions for people in the market? The answer is we don't. Rather, we typically just assume some function that has some nice features. The nice features we're typically looking for are things like they're easy to work with. And this is where financial economists are on thin ice. Many of the functions used in finance are such that only the expected value and only the variance matter. There is much evidence to suggest that people care about other things other than just expected value and variance. For example, many people care about skewness. Skewness is the likelihood that there will be a big positive outcome. Lottery tickets have lots of skewness. In fact, many small stocks have lots of skewness. They either languish or fall from a fairly low price, or they skyrocket. Okay, so why is this important? If we use utility functions that imply only mean and variance matter, then we will have missed some important features of investors' preferences. If we use such functions to build asset pricing models, then the model may imply something is not important when in fact it is. That means that when we use a model to tell us what is risk and what is the return you should get for that amount of risk, it may be completely misleading. Later, when we develop various asset pricing models, I will point out when an asset pricing model has an implication that is based solely on mean variance preferences.